First of all, I want to say thank you for everyone for joining, and especially thank you for to our panelists here. We have with us the lovely Stephanie Shumsky from FinDev Canada. We have Valerie Marcel, who's Associate Fellow on Energy Topics from ChatamHouse. And we have also Michael Waldron, Head of Energy Investment Unit at the International Energy Agency. Unfortunately, I received the news earlier that Carlos Barrera could not join us, but I know about Atlas Renewable Energies project. So if anyone has questions on those projects, I'm happy to provide an insight. And I thought it was interesting to have a point of view from an operator, but we all have experience working with operators on the ground in different countries. So I'll bring that experience also to try to balance our conversation. This webinar is like another one of the series of the webinar we do at Embellie Advisory. Same rules as always. These are ChatamHouse rules. So, and we have Valerie Marcel from ChatamHouse, so we will be very clear on this topic. We can discuss and talk about everything. Obviously, every question is welcome for this webinar. The only thing we're asking is not to copy a quote from someone on this webinar and attribute it to the person that said it, because it's not that will not allow us to be as open in terms of our conversation. These webinars are made to try to share best practices in terms of ESG, on financing clean energy and others. And so it just gets into a series of webinars that we did on local content, on community participation, on these communities. Those that join us and that have that are regular participants know about this. But as I said, we're happy to share the links to past webinars. And I would ask you if it's possible to just ask any question that you have on the chat, and I'll try to pick them up as quickly as possible to create a lovely conversation and try to address some questions that you might have. We'll also, for those, I just use the opportunity to say hi to those that will actually see this webinar in its video format. Feel free to reach out to us after the event. The objective here is to try to highlight ways to try to funnel increased financing opportunities into clean energy projects in emerging countries. It's a large topic, and it's something that we are happy to continue working on in the next few weeks and months. Maybe just to introduce a little bit more our panel, I'll do it one by one. We actually had the idea to launch this webinar after a very interesting publication from the International Energy Agency. So Michael Waldron is here with us, leading the Energy Investment Unit, and actually the lead author of this publication. And so he'll tell us more about it. I'll turn to you in 1 second, Michael. Valerie has extensive experience in especially new emerging countries in terms of energies. We work with Valerie, who've been a part of similar panel on Guyana, on Uganda, on different countries that we actually might address during this webinar. And Stephanie, who I think we already did a webinar a long time ago, Stephanie, on talking about formalizing activities and trying to make sure to lead to sustainable development in emerging countries through large investment, either in the energy or other natural resources sector. And so it's very nice to have you three on board here. Michael, maybe if I can turn to you first, as I was mentioning. And so if you can maybe introduce a little bit, obviously everyone knows the International Energy Agency, but it might be interesting just to frame it a little bit and explain how it works into this space of facilitating, financing towards clean energy projects as one of the energy sources that the IEA covers. I would love to turn to you maybe and just maybe explain a little bit that the publication itself and how the IEA works into this space.
Yeah, sure. And thank you very much for the opportunity. I hope I'm coming up on the screen all right. So essentially, we published this report, Financing Clean Energy Transitions in Emerging and Developing Economies, at the beginning of June. And this report was a culmination of almost a year of a project development. And we recognized during the COVID pandemic that these countries, emerging and developing economies, and when we're talking about this part of the world, we're talking about a wide range of countries ranging from relatively higher income countries in the Middle East to fast growing middle economies in Asia, in Latin America, to lower income countries in sub-Saharan Africa, although we're excluding China from this picture. So China we view as kind of having a separate dynamic. And we see that these countries were particularly affected by the COVID-19 pandemic. They account for 2/3 of the world's population. They only account for 40% of the world's energy investment, and they only account for 20% of the world's clean energy investment. So there's a bit of a disconnect between their potential in terms of economic, socioeconomic development and the role that they play in energy investment. But that said, when we're looking at our scenario results and we're looking at our stated policies scenario from the World Energy Outlook last year, if nothing is done or if insufficient action is taken to transform the energy systems of these economies in aggregate, they would account for almost all the emissions growth over the next 2 decades. So China plateaus, advanced economies decline, but still this would be the part of the world driving emissions growth. So we thought it was really the right time to look at this topic, particularly with regards to the economic situation. And financing is really a critical issue in terms of putting these economies on the right path for clean energy transition. So with that backdrop, maybe I can highlight just kind of 4 big analytical results which came out of the report, and we can, in the subsequent discussions, we can get a bit more into the kind of the policies and the project level issues that we also uncovered. The first is that, so our team, we track investments around the world. We've done this as part of our World Energy Investment Report annually. And the first is just noting that the trend in clean energy investments, and so this includes investments across clean electricity, primarily renewables, energy efficiency and end use sectors, but also looking at clean fuels, low emissions fuels and carbon capture. And we note that clean energy investments across all these categories have been stuck at around $150 billion a year in these economies for the last 5 years. They went down during the COVID pandemic. We only expect a partial rebound in 2021. But the IEA also published a report on net zero emissions roadmap by 2050 in May. And essentially, if you apply that roadmap to this part of the world, we would need to see a 7-fold increase in clean energy investments by 2030 to put these economies and to put the world on the pathway to meet net zero emissions. So this would imply attracting annual investments in clean energy of over $1 trillion a year. This does not even include some of the investments in related grid infrastructure or flexibility. And it's not the entire energy picture. So it just speaks to the huge amount of capital which would be needed in this part of the world. So number 2, in terms of kind of a big message from this, is that we see this as being an affordable transition, but it's really, you have to understand how the nature of spending shifts in clean energy transitions. So in the energy system in the past, because it's been based around fuels, around fossil fuels, you have cost structures which are based on relatively high operating costs compared to relatively low upfront capital costs in many cases. But in clean energy transitions, the shifts with the uptake of more renewables, with things like electric vehicles, that upfront cost of capital, upfront cost of finance becomes even more important. And that's what's going towards funding these new investments. Now, you do get, from a system perspective, savings from reducing operating costs, reducing the dependence on fuels. This is particularly important for net importers of fuels in emerging and developing economies, as well as from efficiency. But in general, the cost of transition is more linked now to the cost of capital and to investments than it was before. So the third big sort of takeaway from the report is that, given this backdrop, we looked at, okay, what are the types of capital which would be needed in clean energy transition? So we tried to model the sources of finance under clean energy transitions. And we find that, looking at today's sources of finance for energy investments in emerging and developing economies, there's a relatively high reliance on public sources of finance compared to advanced economies. So a lot of this is state-owned enterprises, national oil companies, state-owned utilities, but also public finance institutions. There's a relatively high reliance as well on equity compared to debt, which is also reflective of the current capital structure and the current mixture in the energy system. So what we find is that if you're aligning with a net zero pathway, with a sustainable pathway, these sources of finance begin to shift. You need a lot more private capital because renewables, energy efficiency, other clean energy technologies are predominantly funded with private capital. But that said, you still need important contributions from the public sector in certain areas. So state-owned enterprises are still very instrumental in funding network infrastructure, for example, in emerging and developing economies. And the role of public finance institutions actually increases because you need more in the way of catalytic development finance to help mobilize this private capital. And then on the instrument side, also with this changing capital structure, the importance of attracting more long-term debt becomes more prominent. So you get a shift towards more debt in the capital structure of energy investments. And hopefully that debt can be lower cost. Hopefully it can find ways to raise local currency, local debt with long tenors that can support those renewable projects with long lifetimes. And then sort of coming to the last point, maybe before I'll turn it over, is given all this backdrop, one of the big barriers to attracting capital in this part of the world is the difference in the cost of capital versus in advanced economies. And we showed a chart in our launch presentation where we showed advanced economies, the nominal cost of capital. This is just looking at it from an economy-wide perspective. So not even layering on the risk premium associated with energy projects, but just looking at government bonds and country market risk. And so advanced economies are below 5% on average in terms of the starting point for cost of capital. But when you're looking at countries in Southeast Asia and sub-Saharan Africa, the cost of capital can be up to 7 times higher. In these parts of the world, they can be even higher if you're talking about riskier countries or riskier segments. So think, for example, the cost of capital for a consumer or for a small and medium-sized enterprise, the difference can be much higher. And in general, when we're talking about attracting this over $1 trillion annually, 90% of this needs to be in countries with banking systems and capital markets which are underdeveloped relative to kind of the global average. So all of this points to a relatively high bar before you even get to the energy sector for accessing debt finance, for meeting equity return hurdle rates. So all of this puts a premium on having the right energy policy environment and having the right mechanisms in place to help de-risk those investments. And maybe in a subsequent intervention, we can talk about that in more detail.
Absolutely, I think that'd be very interesting to address. And thank you, Michael, for that was a very good intervention to help set the stage of this panel. I'm going to turn to Valerie now, because I know the work that you've done at ChatamHouse. I wanted to maybe have you explain, your vision on the participation of ChatamHouse on those questions and different countries. Obviously, I did see preparing this webinar your participation at the Renewable Energy Efficiency Partnership. That might be very relevant. Please introduce yourself. That'd be wonderful for us, Valerie.
Thanks very much, Remi, and thanks for the invite to participate today. Yeah, as you mentioned, I contribute to REAP, which is the Renewable Energy and Energy Efficiency Partnership, and I'm deputy chair of the governing board of that organization. And what it aims to do is to really advance market readiness for clean energy and energy efficiency in emerging markets like Africa and some parts of Asia as well. But the main sort of role that I will speak to or draw from today is where I'm the project lead for the New Producers Group. And that's an initiative that's co-organized by ChatamHouse, the Natural Resource Governance Institute, and the Commonwealth Secretariat. And the project has been going on since 2012, and it brings together about 30 emerging oil and gas producers. So some are at the exploration phase, some are quite frontier plays, actually. Others are at the development phase. So some of those have very fast-paced development of discoveries like Suriname, while others are more languishing discoveries that may not actually come to market. And then others are new producers like Guyana, Ghana, and others. And we also have some established historical producers in the group to sort of exchange on their long experience. And so it's really a peer-to-peer network. So what we have is different opportunities for government officials to exchange on the challenges that they face and talk about strategies for navigating that. So we don't have ready-made solutions. It's just more of a discussion on what they, what kind of challenges they have. And I think it's really an interesting group of countries that is quite unusual. And it really stands in contrast to the sort of global-wide view that we just got from Michael. Here we're talking about countries that represent 5% of the world's population, but only contribute 0.04% of global emissions. So they have a tiny carbon impact, even though some of them a number of them are producing. They have significant sort of persistent energy gaps. So even though we're thinking of producers, and some of them are already have oil and gas production, they are not meeting their energy needs with that the oil and gas production. They have persistent development needs, especially the members of the group that are from Africa or Latin America. What's really interesting is that they're highly vulnerable to climate impacts and have very low readiness to address those climate impacts. And indeed, if you look at the members of the group that have discoveries, major discoveries, and are in the production phase, they are all ranked globally among the most vulnerable to climate impacts and the least ready to address the climate impacts. So that really shows the sort of, the kind of very challenging policy environment that they are in, because, and it sort of helps understand why they're looking to the petroleum sector as something that can address a lot of those different needs, notably energy gaps and development needs.
No, I agree, and that's interesting that you bring that up, because a lot of the topics that we're going to be talking about are very relevant for some of those countries, new coming producers. We probably will address in this webinar, or I will later, the series of investment we've seen in the petroleum sector, but together with clean energy sector, making sure that we actually have those partners part of the equation towards bringing more clean energy solutions, but also contributing to local development of the territory and the country. And I think that's why I'm very happy to have you, Stephanie, also on this webinar, of the vision from FinDev Canada of investing into a series of energy projects, and mostly clean energy projects, but specifically looking at the kind of impact that it can have on general development, from gender issues to sustainable development. So please, I'm turning to you, because I like to get the perspective from a development agency and FinDev Canada, from how you select those projects and how you fit into this conversation between new producing countries, clean energy mechanisms, and finance, please.
Thanks so much, Remi. And honestly, I'm really glad that Valerie and Michael went first, because they touched on a lot of the gaps that exist in the clean energy financing ecosystem that FinDev Canada was really designed to address. As maybe the newest development finance institution in the world, FinDev Canada was formed about 3 years ago. And as you mentioned, we have we invest in Sub-Saharan Africa, Latin America, and the Caribbean, providing direct loans, guarantees, project and equity financing to private sector companies that are, operating in sectors that are aligned with our impact development goals of market development, women's economic empowerment, and climate change mitigation and adaptation. And, as a development finance institution and an impact investor, we're also really focused on exactly what Michael was talking about, which is blended finance, finding ways to partner with traditional investors and different kinds of lenders that may not necessarily have the same risk appetite that we do to go into these really challenging geographies or, kind of challenging contexts and sectors. And so we're there to kind of offer financing on terms that aren't readily available on the market, whether it's the length of the loan, the conditions of the loan, the interest rates of the loan. So we're here to offer those kind of tough to find conditions for financing, and then partner with traditional investors and other lenders that are interested in maybe a little bit lower risk, lower cost kind of opportunity. So we're here to partner with them, and we're also here for what Valerie was talking about, which is, seeking out those economies and those countries that do have kind of persistent energy gaps and are very vulnerable to climate change impacts, and targeting those areas and those regions for renewable energy project development to achieve, both climate change mitigation and adaptation impacts, but also, positive development impacts, including sustainable development goal related KPIs like access to energy and use of improved cooking techniques and things like that for the local populations.
Oh, very good, Stephanie. Thank you very much. And maybe just to build on this, first of all, I appreciate that people start asking questions. Do not hesitate to continue. We'll just blend them into the narrative of the webinar as we go. But maybe turning back to Michael, I mean, we started mentioning in terms of the in introductory talks, a series of type of policies that can successfully mobilize capital for specifically the clean development project that we want to address here. Can you maybe just detail a little more on this, and especially since Stephanie mentioned the role of development development finance through FinDev Canada, maybe try to see how, you know, development finance can play a larger role in helping catalyze those investments in emerging countries. Michael, I think you're on mute. The first part of your answer was probably the best one, so please come back to the beginning of the sentence. That'd be great.
But in this report, we went sector by sector and we analyzed kind of what are the key issues for investment and what are the key policy issues for investment in many cases. Maybe I can highlight, you know, a couple different sectors and some examples of how those were addressed. So starting with the renewable sector with renewable power, sort of three big areas that we looked at in terms of policies where that help sort of successfully mobilize capital for renewables. One is having, in a country level, that presence of that long-term strategy in terms of the goal for renewables, in terms of target setting, in terms of giving developers visibility that there's going to be a long-term market to develop a pipeline, and then pairing this with a policy mechanism that helps to award or sort of allocate, you know, renewable power, procure renewable power on a competitive basis. So it really just to say, you know, the implementation of competitive auction schemes has been a big success story in a number of economies around the world to attract investment. But that kind of leads to issue number two is you can have a good sort of process for awarding contracts and procuring power. But in many emerging and developing economies, the bankability of those contracts is an issue, and how developers are able to, and banks are able to manage and model the kind of cash flow risks, particularly around the risks associated with the counterparty. So that whether that's a state-owned utility, whether that's maybe another private party. We haven't seen the advent of corporate PPAs so much in emerging market developing economies, but there's certainly a lot of potential there. So there's issues around payment risks and commercial arrangements is another one, an area of policy focus. And then another or last big one is around having that focus in terms of making sure land and enabling infrastructure is accessible. Sometimes this means putting in place things like one-stop shop, which are to help to aggregate permitting and help to streamline some of the processes around that. When it comes to the grid, this is really about sort of long-term power planning, the financial sustainability of utilities, which could also lead into a separate conversation, but I'll just highlight that as being kind of the policy consideration. And a couple of examples that we highlighted in the report, and of course, these examples don't necessarily address all the issues, but they at least address some of them in order to attract capital. So one case study we looked at was the case of Argentina, which is a relatively higher risk country in terms of investment risks, and they're putting in place the Renovar program, which was basically a combination of an auction, a long-term contract awarded by an auction process, with this kind of programmatic approach to offering a guarantee, loan guarantees that were offered through the Argentine government, as far as I remember, and then backed by the World Bank. And this was, I think, the World Bank's first foray into doing kind of a programmatic approach to guarantees. And so this combination actually was able to attract a lot of capital and to build a pipeline of projects in solar PV and wind. So that's one example. Another example we highlighted was in Indonesia. That's more of a specific risk mitigation where a development bank, I think it was the World Bank again joined forces with the government to offer a specific blended finance or risk mitigation facility aimed at getting geothermal projects going. So tackling some of the early stage risks around exploration that make it, raise the bar for geothermal investments in particular. So those are just a couple examples of some of the things we looked at, but there's a number of different examples in the report. Also, as I said, if you start to go into how do you start to finance grids, transmission and distribution, how do you reform utilities? Those are all cases we looked at. I'm happy to go in those directions if questions come up there. Maybe I'll also highlight some examples on the demand side, because we see this as being just as important. It's actually the first fuel for the IEA is energy efficiency. And there are some of the policy considerations are a bit different. So to mobilize investment for energy efficiency, you really need to have in place the kind of regulatory framework, which is around clear energy performance standards, which get more rigorous over time. In some sectors, these take these are expressed through the buildings codes, for example, in the building sector, or fuel efficiency standards when you're talking about transport vehicles. And so having that regulatory framework in place is kind of a first order condition. Another challenge with energy efficiency benefits is that banks are oftentimes not comfortable with the financial case. And so having measures in place to help monetize the energy savings through incentives, through market-based incentives, and also certification schemes can help with this, and also help to encourage the uptake of new fuels on the demand side. So funding those sort of newer applications, being able to attract bank funding. It's important to have the incentives that sort of reward those at the consumer and small business level. And then another constraint is the availability of low cost financing options in general for SMEs and consumers. And so finding ways through green loans or green mortgages to help defray those upfront costs is also important. And a couple of examples we looked at, one in the building side, we looked at the example of Colombia, where they put in place a buildings code, and this was combined with a certification scheme that's managed by the IFC to help certify green buildings. And this allowed some of the banks in Colombia to raise funds to invest in energy efficient buildings in a way where they were able to securitize the projects and raise them at a lower cost of capital. So it was that combination of having that development bank tool with the building standard that really did that. In the transport sector, we looked at a case in Thailand, where Thailand sort of used government incentives to help spur investment along the value chain, along the manufacturing side, in terms of the purchases, and also partnered with the development bank to help roll out some of the first electric buses, which things like, transport can oftentimes be at the extremes in terms of financing, where it could either be you need to have a consumer buying it, or it's a big infrastructure project, which is going to be very publicly financed, something like a metro system or a bus system, which is going to be owned and operated by the government or closely tied to the government. And then in the industrial sector, and this will be the last one, we also looked at some of the prospects for clustering through clustering industrial facilities, with a case we looked at in Oman, which is trying to develop an industrial cluster around the Sohor port, which essentially combines energy efficiency, it combines uptake of renewables, it combines some hydrogen developments and the potential for export. And so this is all kind of packaged in a way where shared infrastructure is made available and the government gives some incentives. And not all of this has been built out yet, but we cited it as a potential model for helping to develop new technologies in a kind of, on the industrial side, in a scalable way.
I'm very happy, Michael, that you mentioned the case in Oman, because when I was in the Gulf 5 years ago, that's actually one of the case that we were looking at when we went to Muscat. Right. That's actually a very interesting project. Maybe just before turning to Valerie on the specific challenges that emerging countries face in terms of mobilizing finance, I just want there was one question on the need for investment that also tackles the need for natural resources such as battery metals and copper for the building of clean energy solutions. Is there like a publication from the IEA that actually tackles the need for specifically natural resources? Maybe Stephanie, later down, if you can actually tackle this, because I know you have experience in battery metals in Africa. That's how we met originally. But I'd like this question to be answered if you can, Michael, and then I turn to Valerie.
Yeah. So I mentioned at the beginning 2 of the special reports IEA produced, the Net Zero report and the Financing Clean Energy Transitions report. In that period between May and June, we had 3 special reports, and the third one was on critical minerals. And so I would just simply refer you to that report, which is freely available on the IEA website, and that would have a lot more information in terms of looking at costs, investments, fundamentals for critical minerals for the clean energy transition.
Are you trying to say, Michael, that we do another webinar on the specific publication on critical minerals? I don't know. We'll see if we do this. But first of all, maybe just to challenge on that one, turning to Valerie. I mean, and I think that's very important to try to focus specifically on emerging producers and the challenges that they face in navigating this transition towards clean energy. I remember at my time at United Nations Environmental Program, we developed some energy finance schemes to try to have Latin American countries, tackle on the access to efficient solutions, efficient devices or appliances, or trying to have access to smart grid solutions. Can you maybe just look at specifically the securing of finance for this transition in the countries that you have operated, Valerie?
Yeah, it's interesting because these countries really face an unusual cluster of challenges that mean that they struggle to to attract petroleum investment and green investment to finance other alternative development pathways. So they've got limited options. They struggle to attract petroleum sector investment because of the very immaturity of their sector. So because oil and gas companies that are listed are really under increasing pressure to decarbonize or reduce the carbon intensity of their assets and to reduce costs. And they can't find those kinds of opportunities in a lot of the emerging producer countries because they don't have the infrastructure to capture the gas. They don't have the market to consume the gas. So there's a lot of sort of, risks related to geology as well. So in other words, they're often just struggling to attract petroleum sector investment, except countries like Suriname and Guyana or others that are in the production phase and have good prospects for exploration. So they're also struggling to attract investment in lower carbon pathways. And it's interesting because these countries are seen as high risk because they're developing countries and they have immature regulatory frameworks. They don't have ease of doing business, good scores on ease of doing business. They have all sorts of different obstacles that Michael has highlighted. And so, even though they have, and because of their vulnerability to climate impacts, paradoxically, they can't get finance, or finance isn't flowing to them, or when it does, it comes with a high risk premium. So it's something that recently Nadia Embellie called the climate investment trap, which is that sort of paradox that these countries find themselves in. So the $100 billion a year that's promised for low carbon pathways through the Paris Accords is not really flowing to these countries. And so it's unfortunate because there's a real opportunity when you're an emerging producer and you haven't yet engaged in the carbon intensive pathway that Nigeria and Trinidad and Tobago have, that you're not yet locked in. There would be big opportunities to help them see the benefits that exist for their economy and their development needs outside of the petroleum sector. And they're just not getting that. And then I think another thing to point out is that they're not getting finance either for gas to power. So that's in that no man's land right now. These countries are using, almost all the countries that we have in our group are reliant on heavy fuel oil for their electricity mix. They also have renewables, but they have large chunks usually of energy needs coming from heavy fuel oil. So gas to power would be displacing that heavy fuel oil, but it's not, there's so much pressure on the investment community not to see gas as a transition fuel. So it's a bit of a catch-22 for these countries because they just have limited options to meet those energy needs, to engage in to find credible options or avenues for low carbon development. So it's a challenging circumstance, I think, for them.
Absolutely, and I agree with you. And you mentioned Guyana, you mentioned Suriname. Indeed, now you're seeing investment trickle down in more, carbon-intensive energy production. But when it came to, suggesting other projects that are more, towards clean can transition, it's much harder to sometimes mobilize finance. And that's maybe the idea of trying to be able to, underline the existing, above the ground risk, obviously. And we mentioned the regulatory risk, but there are political risks and social risks in some countries, and try to make sure to mitigate it. And maybe that actually leads me to turn to you, Stephanie. And you have quite the experience of living in some interesting countries, and we have that in common in not in traveling around Africa and Latin America. How do you actually make the case for mitigating those above the ground risks and just making sure that actors such as FinDev Canada or others can feel secure about investing in clean development mechanism and clean transition in the emerging countries, because the market's there, and obviously the need in terms of climate mitigation is obviously there. So how to assess and to mitigate those above the ground risks then?
Yeah, thanks, Remi. And you're right, we do have a lot of experience on the ground, really addressing these risks kind of head on and watching the consequences play out when you don't do a good job of it. So I'd say that FinDev Canada, like many of our peer DFIs, we hold clients in emerging markets to the same standards that traditional financiers hold clients to all over the world. Things like the IFC performance standards and Equator principles. But the difference is that we make provisions to provide capacity building and support to ensure their alignment with these international best practices. So rather than expecting, 100% perfect environmental and social management system and a full team from day one, we really do understand that they may not be in the same place in terms of the maturity and experience of their organizations with dealing with these issues. So whether it's providing working with our technical assistance facility to share in the costs of providing formal support, like hiring external experts to help clients design these systems and implement them, or applying development impact related lessons on improving workforce diversity and equal opportunity. Or providing informal support for clients, where we're sharing resources and, providing that additional sort of oversight and monitoring of their activities to really help them navigate particularly challenging situations or learn about emerging risks. It really is this kind of additional service that we provide. So it's not just capital, though I am sure that they're happy to get the capital, but we provide this full suite of kind of other kinds of support that really does play a role in helping to de-risk the investment and making it more attractive from an investor perspective, and also, frankly, from a development impact and environmental and social impact perspective.
No, absolutely. Maybe turning to Valerie then, especially on oil and gas producing countries, and how that some of the actors operating in these countries can actually be part of the solution. I just wanted to see, and discuss with you, how can oil and gas companies support emission mitigation in emerging producers? And I'm thinking specifically, we're seeing some changes in some of the deals that are being made. Total Energies, in Iraq, for example, obviously signed a large contract in oil and gas, but also included a large renewable power plant for the Basora region. We're starting to see more and more the inclusion of a larger mix of energy when it comes to bidding on development of energy solution in emerging markets. Do you see these trends continuing? Are there other ways for the oil and gas producing companies actually to be part of the solution, obviously, because that will facilitate the channeling of funding resources in terms of those countries?
Yeah, I think that deal is really interesting. And there's been some interesting research also on how to change petroleum agreements so that they can facilitate those kind of bundled investments and reward investment in renewable energy or energy efficiency, and not just from the scope 1 petroleum sector project, but really things that are completely separate from the project. So that's a new trend, I think, that's set to increase as oil companies have listed companies anyway have really set their targets for net zero ambitions, and so I think that's going to be on the increase. And then you also see just in the way that these projects are being designed in the countries with major discoveries in our group, that there's really efforts to reduce scope 1 emissions. So an interesting case was the Uganda oil discovery, which is a waxy crude. And so it requires a pipeline that has to be heated. And now the project has been redesigned so that they use solar panels to heat the pipeline. So There's also in Suriname, TotalEnergies again was designing the project so that there's a renewable generation at production, and then Suriname is sort of seizing that opportunity to get investment in, you know, either could it be like offshore wind or offshore solar that would benefit Suriname's consumers. So there's now more and more of that focus. But I think that what's interesting is that even though these companies are under pressure for ESG performance, and you know, of course, like achieving Millennium Development Goals is a key part of that, they aren't willing to put in money for gas to power projects. So there's a reluctance there, which I don't think makes complete sense to me, because if you look at a project like in Guyana and Suriname, the associated gas coming from oil production is at such high volumes that it can't be all re-injected and it can't be flared. There's too much gas. So you have to find a productive use for it. And the unwillingness of the companies to fund the infrastructure and the sort of processing of the gas seems to be a big gap. Like that has to be addressed in some way, because the only alternative is to drastically reduce oil production so that they don't end up with all that gas.
And it's, maybe you pointed out something I think is very important, is when we're talking to about emerging markets, emerging countries, we usually talk about countries where the institutional strength of the government or the economic power of the countries is more limited compared to other countries. And we're seeing in Mozambique, for example, the TotalEnergies project is larger than the actual GDP of the country by far. So how do we actually get the government facilitate the capacity to have this kind of capacity of negotiating for more investment in infrastructure, for the inclusion of renewable energy projects, and then move away from the classical trend, which is let me develop the fossil fuel, whether it's petroleum or it's gas, and therefore thanks to the subsidies and royalties that we'll get from this, I will then reinvest in renewable energy. And that comes of this weird situation where you actually try to engage oil and gas, you have to get all your eggs into the oil and gas production to then be able to diversify in renewable energy, rather the other way around. Maybe if I could get your thoughts on this specifically in some of the countries, and then I'll turn to Michael specifically on trying to remobilize different ways of financing, because I have a few ideas on this. What's your take on this reaction between government strength and the company itself, and how can we use maybe other actors to try to offset the balance and propose solutions that would be more comprehensive and therefore more efficient in the mid to long term?
Yes, I mean, I think there's a lot of good advice given to governments on how they can stop flaring, stop methane leakage, and all sorts of low carbon pathways that they can follow. But then the practice is on a completely different like reality plane, and there's a lot of conflicting incentives or different interests that are involved in this, and I think it's very challenging in practice to do it. So, for example, for flaring, the governments usually will have a no flaring policy, but the Ministry of Finance will want the production to be ramped up as fast as possible, that they have export revenues so that they can invest in the critical areas that they want to invest in. But then the Ministry of Environment, or the EPA, is struggling to stop the flaring because it's got no muscle and is under-resourced to be able to really confront an oil company in that. And so they get sort of skewed incentives because they can place penalties on the oil companies that are pocket change, but for the EPA is big money because they're under-resourced and under-financed. So you end up with these kinds of situations that make it institutionally very and politically very difficult to stand up to oil companies. And I think now oil companies are the ones changing increasingly. So they're the ones instigating a lot of the improvements in emissions. But I think we should never forget that the United States is one of the worst emitters in terms of carbon intensity and methane leakage. So high capacity, high regulatory capacity doesn't necessarily translate into improved outcomes.
And obviously, there's a lot of other variables, from economic situation to political capacity of lobbying different institutions, which is probably the case in the US without mentioning too much of it. But I think that's thank you for making that point. Indeed, that we tend to give a lot of lessons, or want to give lessons to emerging countries, where sometimes also in our backyard we have to look at how to try to improve our own situation. But I'm very interested, and thank you for this. Maybe turning to Michael, when we look at trying to mobilize additional finance for projects that are not obvious to finance because they're coming from emerging countries, politically risky countries, or countries that don't have a track record into clean energy projects, and therefore that doesn't reassure, that doesn't give the kind of securities to the investors that the project will actually happen, will develop well, and that afterwards you'll be able to make a return on your investment. How can we actually mobilize other actors? And obviously, the capital markets come to mind. I'm just flying back, and I took the red eye from Colorado. That's why I have my glasses on and my little eye right now to enable conferences on trying to mobilize finance from capital markets for mining project in that case, but in countries such as Nicaragua, such as Bolivia, such as up and coming countries where the traditional financing organization will not go. How can we try to get the same element for those countries, the same structure for those countries to finance solar projects, wind projects in countries that are very much on the side of traditional funding opportunities, but where the development of those projects will be as critical, obviously, at the global level for emission reduction, but will then allow the countries not to just put all their future into either oil producing or other generating income generating sectors. So please, Michael, that's a tough one for you. I'm sorry, but that's the one I really want to have an answer on.
Yeah, and I used to live in Colorado about 20 years ago, so I know it's a nice place. So although I never took a red eye flight from it. So in the report, we kind of had some pretty strong messages around kind of two broad buckets of funding. And whoops.
You're back.
Sorry.
We didn't see anything. Continue. That's perfect.
Yeah, exactly.
This in the video, maybe. We'll see.
To move my arms at all. So we talked about kind of two broad buckets of finance, which is really critical to mobilize this larger form of private finance. And one is the development finance institutions. And there, one of the main messages from the report was that okay, these institutions have put forth sort of certain targets in terms of climate finance. Not all of them have. All of them across the board need to have a strong strategic mandate. There needs to be a more unified focus for development finance institutions internationally on finding clean emissions reductions and clean energy transitions. And this needs to be rising over time. And there'll be something more we say about this in the World Energy Outlook, which comes out in a couple of weeks. But also recognizing that these institutions on the international level can function best in terms of allocating capital when you have institutions on the local level, such as green banks, such as infrastructure banks, which are helping to do that kind of local facilitation, project development, capital allocation. So really having this ecosystem of a robust system of development banks at the international level and at the local level, totally geared towards financing clean energy transitions, is still something which is missing from the international picture and in some of the countries that you talked about. This is also related to this broader sort of tranche of international climate finance, which advanced economies have promised to developing economies. And so meeting that $100 billion annual goal in 2020 is a first order, but this also needs to be raised over time. And then the importance of blended capital and enhancing the deployment of blended capital in situations to address some of the examples you said before. So you have a mature technology like renewable power, but it's in a risky market. It's being deployed, first of a kind project in a risky market. You have mature technologies such as those related to energy efficiencies, such as buildings, et cetera. But developers and financiers aren't really comfortable with the financial case. And so this is where blended finance can also play an important role, albeit maybe through a different type of instrument. Maybe it's through making available lines of credit and pairing this with capacity building to help the banks evaluate the case. And then deploying risk capital maybe in the form of equity to help to get going some of the early projects in low carbon hydrogen or CCUS, also grants. This is also another important purpose of blended finance is to help those new technologies where they don't have a commercial case in any type of emerging market right now, although it's in some it's more cost effective than in others. And so we also talked about ways to mobilize the capital markets. And here we didn't go into as much detail, but we basically highlighted this notion that capital markets need to increase their allocations broadly to clean energy and also into emerging and developing economies. So not putting clean energy aside, they're under allocated into this part of the world to begin with. And so this represents a step change for capital markets. Sustainable finance frameworks as they're being developed in terms of the financial rules, whether around the European taxonomy or around some of the kind of privately led frameworks done by the different types of asset owners alliance. I think there's a net zero asset owners alliance that's developed some principles or framework. These are making a lot of progress in terms of identifying the sustainable investments, so the clean energy investments. There's challenges with the sort of transition investments, which also goes back to the points that Valerie was raising, the role of gas and how it can serve decarbonization in some purposes, but how it also is tricky to address in sustainable finance frameworks, and also depends on the larger energy system context and needs to have an understanding of how those gas investments will be utilized over time beyond the sort of immediate emissions reductions potential. And so that's one area, the capital markets needing to develop more robust frameworks on how do you engage with some of these emissions intensive sectors on credible transition strategies, how do you monitor them over time, how do you make sure that they eventually align with the outcome we need to see, which is getting to net zero by 2050. And then another sort of piece of recommendation we gave regarding the capital markets is that, also that focus on sustainable finance and, let's say it's easier for an investor to invest in kind of the low hanging fruit where things are clearly low emissions, rather than investing in a company or a country which maybe has a higher emissions profile or is coming from a lower starting point for clean energy transitions. And so when you add the risks of investing in emerging and developing economies with that kind of largely higher starting emissions profile compared to advanced economies, this also means that sustainable finance tends to underserve the emerging market and developing economies. So finding ways to bring them in explicitly in terms of the frameworks being developed, but also recognizing the broader benefits to finding and saying the sustainable development goals, which go beyond energy as well, but which have important development aspects to them, and are closely linked with the sustainable pathway. So those are kind of the broad points we gave about how to bring in some of these other sources of funding and the role that they play in the clean energy transition.
Yeah, that's perfect. And talking about transition, you actually give me a perfect transition also to Stephanie, because you mentioned the importance of those projects towards a larger scope of sustainable development. I'm going to ask you a question, Stephanie, but just before, because of time, I think afterwards we can actually maybe have a round of concluding thoughts. I've seen Valerie taking a lot of notes, so I'm sure that she has a few key thoughts that we want to keep for the audience. A question that I received from people from the audience. Obviously, the recording will be available as always on our website, but also if you don't want to wait for us to package it nice for the video and the introduction, you can actually find it on YouTube very quickly, probably 2 days from now. So just feel free to go there. We want this to be shared as widely as possible for best practices. Turning to you, Stephanie, therefore, and we've talked about mobilizing other sources of finance, maybe to bundle with development finance. Obviously, FinDev, if you could trickle down additional actors, private actors to participate in some of your investment, I'm sure you'd be very happy. But my question on this would be, how do you select those projects? So I think that what's very interesting in terms of having an actor like FinDev, part of those or others in development finance, is to actually set the pointer towards those projects that not only have obviously a very strong interest in terms of producing clean energy, a return on investment and others, but also that are very much integrating into another larger scope of areas of development, and therefore kind of setting light on those projects that might be more productive in having positive output and externalities outside of just the scope of energy. How do you actually select those projects, and maybe can you actually bring up some ideas of best practices maybe in Latin America or Africa, because I've seen that among the attendants we have people from a lot of different countries. That's a long question for you in five minutes, please.
Yeah, thanks so much, Remi. Well, I guess it's interesting to hear from Michael and Valerie, what they've identified as kind of gaps in the market and particular sectors or countries where financing is difficult to obtain, because I'd say that FinDev Canada is looking for exactly those, tough contexts and difficult financing choices. As part of our investment approval process, we actually have to prove additionality. So we have to, when we're bringing a transaction to the investment committee for review, we have to prove that, there's no one else that can fund this, that we're doing a project that's the first of its kind in a country, or that we're meeting some kind of particular, financing need that exists that's not being met by anyone else. So, tough countries, tough contexts, new projects, new places, that's exactly what we're looking for. But, in order to have access to that, very special financing that we are offering, you need to kind of go beyond the minimum requirements. So if you're, looking to develop a solar energy project, even if it is in a challenging market and it's the first of its kind, but you kind of want to skate by with the minimum required environmental impact assessment and bring in a 100% male expat workforce and, not necessarily engage in any creative benefit sharing or stakeholder outreach with the local community, then we're probably not the lender for you. So I think, operating in those challenging contexts and also having, the vision and the foresight and the commitment to go beyond minimum requirements and really look towards aligning with international best practices and finding, sort of complementary development impacts. So not just climate change mitigation and adaptation, not just, megawatts of renewable power that's produced, but also, how many women and vulnerable people can you hire from the local community? What kinds of long-term sustainable development impacts can you have? How are we making sure that the power that's being produced is going to, local community members and small businesses and, becoming an engine to drive development rather than maybe going to support, heavy industry or large cities that maybe already do have access to some of this energy from other sources. So we're looking for a variety of factors, but I'd say the biggest thing we're looking for is commitment and an open mind. And so whether those are projects in Africa, like, our investee companies that are developing solar projects in Malawi and in Pakistan, our friends at Climate Investor One who are doing run-of-river hydro in Uganda, these are tough places to do work, and these are, really interesting kind of cutting edge projects that they are doing. And then they've also got that kind of great commitment to development impact, whether it's having women on their management teams and boards of directors, or, seeking out ways to develop, job training programs and engage with the local community. It's that kind of tough places, tough context, but really like long-term development vision and being kind of internalized as part of the company's DNA.
Absolutely. Thank you very much. And actually, when we mentioned this, the capacity of making like a larger impact on other issues and ESG related issues, actually, even in non-sectors that are not renewable energy, we're seeing much more, addressing elements of ESG and much more, even for capital markets oriented conferences. That's like a step in the right direction. But that really, when you look at the capacity to make an impact, obviously emerging markets and oil and gas traditional producing countries are probably the ones where you can actually see the largest impact. I'm thinking about, Guyana, Suriname, Uganda, Mozambique, other countries that we have mentioned. Maybe Valerie, if I can turn to you first for the like concluding thoughts and what you would like the people that would watch this webinar to come home with, like the one or two thoughts, please. That'd be great if you can go there, and then I'll turn to Michael and Stephanie for the same thing. Ask any question on the chat if you have to, because that's the last chance now. But please, Valerie, first to you. What would be the first one or two concluding ideas that you want people to come up with?
Well, in terms of the takeaway, I think it's from my perspective, it's really offering viable, implementable options to countries that could go down the route of the race to the bottom and producing their oil as fast as they can with disregard for reducing emissions and those kinds of softer targets that Stephanie was just mentioning. But then I think I just wanted to add some points, maybe more with my REAP hat on, which is that, I think some of the key obstacles to getting finance to clean energy or energy efficiency projects that we've found is to have a project pipeline. There is finance, but there isn't the sort of bankable projects in a pipeline ready to go. And so getting those projects market ready is one thing that REAP does. And the second thing is that there's a huge exposure to currency conversion risk, because a lot of the grants come from Canada and Norway, the UK, etc. And so the projects are often quite exposed to that kind of risk. And so there's a real need to have green reserves in local banks in Africa and Latin America and Asia. And I think that's the other area where REAP is really trying to have an impact, is to develop a green bank model in these countries so that they can have that, reduce the exposure to currency risk.
Thank you very much, Valerie. Before Michael, I'm just going to take that question from Ashley Ahmed. It's a very interesting question in terms of trying to tackle a challenge which is very present in terms of finding the right experts, contractors, suppliers for different projects, especially in clean energy. That's the case actually in most emerging markets, also for oil and gas projects. If I can just put my 2 cents on this, when there's ESG, that's an assessment of a project. I mean, those ESG assessments now need to include, if it's not the case, that's a real problem, need to include the capacity for local content. I mean, we've done a series of projects for community suppliers, development programs, or trying to find the right partner of being able to be present, to do the training, to encourage the local workforce to be part of this. There are a series of new methodologies in place, new tools, whether it's community participation platforms, whether it is a series of webinars that can be passed, or training tools that can be passed to the communities. And actually this pandemic has been quite active into developing new forms of addressing those issues. But indeed, the capacity of finding the right partner in countries that are sometimes up and coming, whether from the Ghana Shield, from Sub-Saharan Africa, from other places in Latin America, is trouble. But there are, and we do it in certain countries. I know FinDev also is very, very cautious of being able to point towards the correct partners. There's very interesting networks also from Global Affairs Canada, from them in terms of Canada, but also other embassies that can be good. But happy to give more thoughts to that question and come back to your question, Ashim. But I'm going over time, but there's plenty of ways to address this, and some of the webinars we did in the past actually tackle that. Michael, it's to you. If I can turn to you for your concluding thoughts, and then we'll finish with Stephanie with the high responsibility of giving the last words of this webinar. Please, Michael, all yours.
Yeah, thank you. I mean, I'll be brief, but I'll just note that there needs to be a focus on improving the national policy environment. So there's a lot which needs to happen on the national level. This has to do with addressing a lot of the cross-cutting issues that relate to infrastructure project development in general, also relating to the local financial system development, which we've heard, development green banks is also a really good way to help that further along. And then there's a lot of progress which would need to be made in various countries in terms of improving the specific sectoral incentives, sectoral regulatory frameworks for developing whatever type of clean energy technology would fall under those. But I think, a big takeaway from our report is that, as much that needs to be done at the national level and at the level of the emerging and developing economy, is that there needs to be some sort of international catalyst to help this along in the form of international finance, funded finance, and also in the form of related capacity building and technical analysis and technical assistance and good analysis, energy pathways to go along with that. So that's what we hope, people take from it, that it needs to be really a collaborative effort between the international community and the developing economies who need to attract this capital, because at the end of the day, if not all countries win the race to net zero, then nobody wins the race, which is a common phrase our executive directors has given. So it behooves the international community to make investment in these countries as much of a priority as investment in their home countries when it comes to meeting global environmental goals.
Perfect, thank you. And I'm going to turn to Stephanie, but just a few things. First of all, these conversations are just made for us to start, thinking about new ways of tackling those issues. So when I'm seeing, thank you for the nice votes. I think it's interesting, panel that went too fast and give them. We're actually going to be developing new ideas and new conversation on this. And please feel free to reach out to the panelists. Also, if you have some ideas or questions, and try to make the most out of it. Maybe the last question, therefore, to you. I mean, I don't know if you saw that, Stephanie, maybe helping you on your concluding thoughts from Ken McGee, if I remember Ken well. I was specifically interested in Ghana and in some countries in Africa. How much are the ESG considerations really considered when financing decisions are made, basically? I think that's an easy ball for you. That's what you love talking about. Can you just rebound on that question and just maybe give the conclusion on this panel? That'd be wonderful.
Yeah, absolutely. Well, and I guess, I mean, it depends on the institution. I can only speak for FinDev Canada when I say ESG considerations are integrated throughout the transaction decision-making process, you know, all the way from pre-screening to triage to the investment committee, the board of directors. At every step of the way, you know, ESG risks and mitigants are included in the discussion, as well as development impact objectives and opportunities. So for us, it's really part of the process. It's there just alongside the financing decisions and then risks, credit risks of any investment decision that we're making. And I hope, you know, I think that's the recommendation that we're hearing from lots of different think tanks and lots of different organizations, is that that's how it should be. I guess just to conclude and say that I really do hope that people that are looking for financing, projects that are looking for financing, consultants and service providers that are located in these regions that are interested in joining forces and you know, helping companies develop their systems and audit the risks on the ground. I hope that they do reach out after this call, and that we can continue working together to sort of close these financing gaps and support the all of the countries that are trying to implement renewable energy solutions and achieving their net zero goals.
Exactly, and that was the first of many conversations maybe to come, especially on topics. Things. I mean, I'll be in Paris with the IIA to talk maybe on critical minerals soon, and then obviously I talked to Stephanie and Valerie often. We're going to try to get those ideas around. So feel free to reach out to us in the next coming weeks and months, and we'll continue on discussing on how to achieve this financement to clean mechanisms and clean sources of energy in emerging markets in the next coming months. So please, thank you very much again to the panelists, more than anything, for joining me this morning or this afternoon for those that are in London and Paris. And I thank you also for coming. We'll just send you the videos when it is available. And I wish all of you a good evening and a good rest of the day. Okay, thank you very much.